Today we have some interesting questions that came in from someone that follows me on Twitter, Will the Trader. His questions, there's a few questions here. We're going to go deep into them, and I'm paraphrasing them here. The first one is that he was going back and forth between a strategy that I actually follow or started to, that I learned from, and now I've kind of adapted it to my own, called CanSlim. So he was going back and forth between CanSlim and straight up technical analysis, not really looking at fundamentals at all, and he was kind of getting confused, and so needed some help there. He also likes my way of filtering based on that ideal growth stock screen in that video that I shared. I'll link it somewhere up here. Thank you very much for that. I appreciate it. But sometimes I trade stocks. You notice that I trade stocks kind of like Blackberry that don't always fit that mold of the ideal growth stock or any of these other scans. So why am I doing that? Go into that as well. He also mentions that he has a small trading account and that it'll be difficult to split strategies. And also, seems like he had a question about different time frames and how that could come into play. And so I'm going to go into all this, so sit tight and we'll go through it. So you mentioned that you've been trading for about 3 years now, so I imagine that you probably already know that there's about 1 million different ways that you could trade the markets, and there's so many different methodologies and so many different ways that you could trade within those methodologies, and there's so many different ways that you could be successful in the market. There isn't just one way. You don't have to just do it O'Neill's way, or you don't just have to do it my way or somebody else's way. What you're eventually going to develop is your own way of doing things. So you'll take the best teachings that you can from O'Neill that apply to you, that you believe in. You'll take some of my stuff, you'll take some of someone else's stuff, and you'll follow each of those, and then the pieces that make the most sense to you will start to come into your own trading, and you will begin to evolve it. That was my experience when I first started trading. When I first started trading, I read O'Neill's book. Happen to have it sitting over here, How to Make Money in Stocks. It's a great book. I read this one probably at least a dozen times and have gone through it and read it and treated it like a textbook. It really is that solid, and the teachings in there are great. I also attended a lot of the Investors Business Daily workshops, and they're taught by different portfolio managers from Bill O'Neill, and what I learned right away from those workshops, as the different speakers were talking, each one of them trades the CanSlim methodology in their own unique way. Some of them are trying to be exactly like Bill and go for those home runs where you find one of these monster stocks early before anybody else does, researches the company, knows the story very in depth, and then waits for it to base, and then hold on, and then latch onto that one and ride it for a few 1,000%. And there's lots of examples of how Bill did that in the book. Then there's other people that have kind of adapted that methodology of finding and zeroing in on the best growth stocks, and then trying to do a swing trading strategy around it, where you're going for more singles and doubles versus those home runs, where you'll be in and out within say a couple of weeks, couple of months, and taking your gains a lot more quickly. So, right, one of the things that I learned about myself is that I like to try and test a lot of different things, and I like to evolve. So one of the ways that I learned to deal with that, and when I first started out, I was trying to do everything in just one account, and that turned out to not be such a great idea, because I would test one idea in that account, then something else would come up, and I would want to go that, but I'm still stuck in this trade over here. And so I would end up making decisions for this trade based on the one that I want to trade over here that are both different methodologies. And so, well, what ends up happening is that you have too many different variables coming into this one account. And while this strategy works by itself and this strategy works by itself, when you try to put everything together, that's where a lot of the confusion came in. At least that was my experience. So what I ended up doing was just having a separate account for this over here, and this is going to be my swing trading account, and this over here is going to be more of my intermediate term account. So I'm breaking up both accounts based on time frames and also based on methodology. And those are the two accounts that I have right now. I also have a third account, a retirement account, but that's kind of separate from all this. I'll talk about that towards the end in a few minutes. So let's talk for a minute about my way of filtering stocks and how it kind of came out of Bill's book. So there's a lot of different things that I look at. There's a whole video series on what types of stocks to buy. There's also a blog post where I outline all of my scanning criteria as well as this ideal growth stock screen. And the purpose of doing that is because historically, the stocks that have gone on to make 100, 200, 500% gains or greater, most of them had the same common traits. At least that's what Bill O'Neill found. And he wrote them all in that How to Make Money in Stocks book. And I took the criterias in that book and I created scans around them, and then I overlaid this ideal growth stock screen so that way I could see by what percentage this stock or that stock is passing this ideal growth stock screen, and then I could just focus on those. So it's a way to eliminate 99% or 99.5% really of stocks that are out there and just focus on this, because if I'm only focusing on these stocks for this one specific methodology, then I'm going to save myself an incredible amount of time, and it's eliminating a lot of possibilities of other things. Yeah, there could be a lot of other stocks that are setting up and breaking out, but if I'm just focusing on these, then I'm not picking random stocks, and I'm not increasing my chances to fail. I'm just focusing on a narrow screen, and sometimes that really helps us improve our gains. And so that's why I was filtering based on that, and I was doing that all on my own. Then I met Adam Sarhan. And Adam has his own way of screening for stocks, which works very well too, which is more just focusing on what's working. Well, which stocks are leading the market, and not really paying too much attention to the fundamentals. Of course, the fundamentals are important, but it's more about what types of things are leading the market right now, and then following those and having a deeper understanding of maybe why these certain stocks or groups of stocks are leading the market higher, and then waiting for the leaders to consolidate and then trading those. That's another very valid way to trade, and it's one that's worked as well. He's created a model portfolio. We have it in our advanced stock report service, and that portfolio has outperformed the market since I started trading that in my own account that I've been tracking myself. And in 2016, it doubled the S&P 500. In 2017, it tripled the S&P 500. So last year, it came out with about a 60% return. And his way of trading is different as well. So he's still looking for those bigger consolidations, but he's trading on the intermediate term time frame. Whereas me personally, I'm a lot more comfortable trading on my own on the shorter term swing trading ways. But I want to get better at trading intermediate term and holding for the bigger moves. So I was able to hook up with him and watch how he trades the model portfolio and then take those trades trade for trade. And by actually doing, I'm also learning. So when he picked up Adobe last January, and it was riding up, and we have a couple of other videos where I show this as well, where it's running up, and then it has a sudden correction, and it's nasty. If you're looking at this on a daily chart, it's just absurd. And for me personally, I probably would have gotten shaken out if I never met Adam and if I wasn't just following the model portfolio and trying to learn. But it had some nasty spikes down, and then it ran up some more, and then it was trending below the 50-day moving average. It was below the 50-day for maybe about 2 weeks or so, if memory serves correctly. But it's having somebody else following him and what he's trying to do and how he's trading. That's teaching me what it really takes to hold for some of these longer term moves, and to be able to see what kinds of things he's looking at, and what it really allows too. Different types of support levels, different types of moving averages and trend lines, and it's a different way of seeing the market and trading. And again, there's no one single right or wrong. Both methods work. My swing trading works. His intermediate term trading works. It's just keeping both of those separate, so that way they could each do their own thing and work separately. If we tried to commingle them, then it just simply it would be a mess. For Blackberry, the way that I found Blackberry, it wasn't something that was in the model portfolio. It was something that was included in the elite stock setups that Adam puts out. So within the advanced stock reports, there's another section called elite stock setups, and it's all the stocks that he finds each week. He picks out the 10 best ones that he's looking for, and he'll include those in the advanced stock reports. And we've also broken that section out for people that just want stock setups. And we have a separate service called Elite Stock Setups. And I found Blackberry in there. He had spoken about Blackberry in mid-December, right before it had reported earnings, and it ended up breaking out and did very well after earnings. I didn't buy it then, but because he had spoken about it, I kept it on a separate watch list, and I saw it begin to consolidate. And while it was consolidating, that's when I did a YouTube live video. I think it was on December 28th. I'll link that somewhere over here too, if not, down in the description. But I saw it pulling into its 21-day exponential moving average, and I saw the volume beginning to dry up and the price action beginning to tighten up as it was pulling back. And so I decided that, yeah, Adam had highlighted it. It wouldn't have been on my radar otherwise, but because he picked it out as a leading stock, and that it had reported and it was doing phenomenally, and it was now forming another way to enter, it was on my radar. And so that's why I decided that, okay, this is something that I'm going to go into and try to trade. And it's something that happened to work out extremely well. It doesn't always happen. Well, the more important thing, rather than which ideas I'm going to get, so you want to have good ideas. You don't just want to trade any stock. You don't just want to enter at any old price. You need to know exactly where you're going to enter and where you're going to exit. But it's more about the strategy, the methodology, how you're managing risk, and the position size too. Those are the things that are really going to determine whether or not you win or lose in the market. If you risk too much, then one bad trade and you're going to blow up. If you risk too little, then you could have a monster trade and it'll be meaningless for your portfolio. So you have to find that sweet spot. and it's within that sweet spot that you'll end up succeeding. And yes, it's not as easy as it might sound, but if you continue to persevere and you continue to educate yourself by watching videos like these, by reading lots of books, by following the right people on social media, by journaling, and by studying yourself and learning about yourself from yourself and learning about markets, you will do well in the end. So you mentioned that you have a small trading account and that you think that it might be difficult to split that one trading account into two different accounts, so that way you could test things out. So there's a couple of things that I want to mention. The first is that there's a lot of brokers out there that allow you to have very small balances and have close to, if not zero, transaction fees. The first one out there is Robinhood. Robinhood will allow you to open an account with anything at all. You could open it with $5 and you can trade for free. So no transaction fees. So let's say you open that account up with $1,000 or $500. You don't need to worry about having enough gains just to cover your transaction costs with that broker. So that eliminates that. Then there's a lot of other brokers that will allow you to open up an account with anywhere between $2,000 to $5,000. That's about the lowest that I've seen on average. And most of the rates are anywhere between $3 to $5 per trade. So that's obviously more expensive than Robinhood, but it's a good start and a good way to keep things separate. Something else that you could try if you don't want to split up your one account, and I'm not a huge fan of this, but you could have your one strategy that you're going to trade in this account over here, and if you pick whichever strategy you're most comfortable with and is working the best for you, and just focus on that one in this account, and then set up a paper trading account with either your broker or wherever else, and trade that methodology over here, right? So this account isn't costing you anything, and you have your money in this one, and that's the account that you're focusing on. I don't like the strategy. I've tried it, and some of the problems that I've run into with this is that I'll start to do better in the virtual account than I'm doing in my a cash account, and so some of the ideas will start to bleed into this, and then this account kind of gets distorted. And so that was one of the reasons why I ended up splitting my account and having these two separate accounts where I'm trading them both with real money. Also, if you're not using real money, then you might not care as much as you do about this account, and you might end up treating it differently than you would the account that actually has real dollars in it. So just because you have a certain type of performance in a virtual account doesn't mean that it's going to carry over to the real account, because when there's real money on the line, we tend to behave a lot differently. So it's another strategy. Not a huge fan of it, but if that's something that you think that could work for you, then by all means, try that out as well. So your last question about time frames, there's not really one right way or wrong time frame to trade. It's really going to come down to what are you most comfortable with. Are you somebody that's more comfortable swing trading? Are you somebody that's more comfortable trading intermediate term or long term? And also, what does your lifestyle allow you to do? So if you're somebody that works a full-time job and you don't have the ability to monitor stocks intraday, then being a day trader might not be for you. You could swing trade. I have a full-time job and I'm not able to look at the markets all day long, but I'm still able to swing trade, and the way that I'm able to do that is by doing the homework at night on the weekend and having a game plan, and then the orders are just placed with the broker, and I use buy stops, and they're just sitting there with the broker. So once the trade is triggered, I'm in, and then I'll attach a stop loss order with one of my brokers. One of my brokers is Interactive Brokers, and so they allow you to set up those kinds of trades. If for my Robinhood account, I'll get an alert saying that this was bought, and then I'll just go in and I will enter the stop loss order at the first opportunity that I have. And that's really it. Like during the trading day, I'm only spending maybe about 5 minutes or so towards the end of the day to actually go in and check the market and see, is there some kind of a manual exit that I need to do, right? So were one of my profit targets hit? Was there a sell signal of some kind that I need to go in and act on? And if not, then I'm just sitting there and letting the trade progress and updating my trading plans, and that's really it. So you can swing trade and do that part-time, but also if you are somebody that wants to trade intermediate term, then following the model portfolio, that for me, that's literally just reading the report on the weekend, spending 5 minutes, and then updating the orders. And all that's really done in about 5 minutes on a weekend. And then we get 2 intra-week reports, and most of the time the stops tend to stay the same and they get updated on the weekend if need be. Every once in a while there'll be an update where we need to update the stops, but because it's intermediate term, it's relatively lower touch. So yeah, like 5 minutes a week, like anybody could spare 5 minutes a week in order to take advantage of the markets. Is really, I can't really think of a reason why somebody wouldn't be able to do 5 minutes for the market. But anyway, if you're watching this video, I assume you do. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions at all, please leave them in the comment section below and I will personally help you. Also, if you like the video, click that little thumbs up button. That really helps us out a lot. And also make sure that you subscribe to the channel so that way you're going to get all of our updates. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.